Folks, thanks for joining us today. My name is Rob Eyler. I'm a professor of economics at Sonoma State University, and I've also been working with the California and Nevada Credit Union Leagues as an economist. And I'm also on the board of Redwood Credit Union in Northern California. And today we're joined with Scott Johnson, and the CEO of Community First Credit Union, and Kevin Miller, the CEO of Travis Credit Union, to talk about our region and to talk about some of the things that are affecting members in our credit unions here in Northern California. Thanks, guys, for joining us today.
Thanks for having us.
Thanks for having us.
Of course. So what I want to start with is kind of a general question is, what do you guys think are the two biggest challenges that credit unions and really specifically members face in the coming year from what you're seeing at your credit union? Kevin, we'll start with you.
Sure. I think one is just a general cloud of uncertainty for members. So I think they're trying to make sense of, you read one headline, it says we're going up. You read the next headline, it says we're going down. So I think there's just this general sense of uncertainty. That's the first thing. And then I think second, a lot of people are asking the great question around, who do I trust for financial advice? And so I think for members in our communities, there's a lot of open discussion happening around who's a trusted partner, where do I get that information from? So I think we see those kind of two common themes kind of across our member base.
And Scott.
Yeah, I mean, it's hard to pinpoint just two. When I thought about this, it's such a unique operating environment in so many ways from what we've seen pre-COVID, and obviously with all of the volatility and turmoil and uncertainty over the last few years. But if I had to pick two that I spend a lot of time thinking about, it's continuing tightness in the labor market and what's going to happen with inflation. Meaning, is policy sufficiently restrictive enough, or does the FOMC have more work to do? And, penny for everybody's thoughts. You just don't know what's going to happen in such a unique operating environment. But, what I find interesting is that this labor market is just still really, really tight. Unemployment is still historically low. And one of the challenges, I think, for all Sonoma County employers, folks who operate in the North Bay, is filling vacancies. I think this is a challenge for all employers in our footprint based on the conversations that I've had with others. And I read something interesting recently that net population growth in our markets is essentially flat or a little bit lower over the last 10 years. And ultimately, we're a service-based organization. We exist to provide great service to our members, just like every other credit union out there. So I think recruiting and retention are key issues in such a highly competitive industry as ours. The other part, and my co-panelist here touched on that, is what's going to happen with inflation in the economy. There is so much incredible uncertainty out there right now. Will we have a recession? Will it be the elusive soft landing? Will it be considerably harder? All of those things have such a huge impact on monetary policy and interest rates. And we're a rate-sensitive business on both sides of the balance sheet. Look, things were largely stable pre-COVID coming out of the last financial crisis, but today there's all this uncertainty and volatility. And I think how CUs navigate this environment with their members, how they continue to grow and provide great services and products to our members, is obviously very critical at this time.
Well, let me ask you a couple of follow-up questions, because you guys hit on some points that kind of tie into some other things I've been seeing the last couple of months. So how much do you think that uncertainty on the micro side has been driven by what we saw with Silicon Valley Bank, with First Republic, kind of the volatility around where to put my money? And what was some of the messaging that y'all did in terms of talking to members and trying to stabilize at least that piece of uncertainty that kind of, for a lot of people, probably kind of came out of the blue?
Yeah, who would you like to go first on this one?
Scott, okay. Please.
Okay, I'll take a run at it. So interestingly enough, I spent 25 years in Orange County prior to moving up to the North Bay about 2 years ago. And I was down in Orange County when the Silicon Valley Bank crisis hit. I was visiting my son down there at UC Riverside. And the first thought that I had was, oh man, this is a big deal. And this is going to have serious repercussions to our industry in ways that we haven't even fully realized yet, So the messaging for me was pretty simple coming out of that. We try to be very authentic. We try to be very straightforward with members. And we try to focus on that core philosophy of, look, we're not Wall Street. We're Main Street here. Our depositor base is radically different than Silicon Valley Bank. I think I saw somewhere in the neighborhood of 90% uninsured shares. We don't operate in those spaces. There were a lot of business accounts, a lot of Wall Street money that left. And I continue to just stress the things that you know we all stress, which is the safety and soundness of the credit union industry, our commitment to Main Street, not Wall Street, and our capital position, our regulatory net worth position is strong, our liquidity position is strong, and we're not going anywhere. So your money continues to be safe with us.
Kevin?
Yeah, and I'll pick off where Scott kind of finished up because I agree with everything he said. I think the other thing we all had an appreciation for is during times of uncertainty, you focus on kind of consistency and calm of message. And more importantly, you do not talk about what's happening at other institutions. It's really, really important. Like, you don't throw shade when things aren't going well. And so Scott's organization, Travis, what we talked about was we're going to focus on Travis itself. We're not going to comment on the other institutions because I think we all have friends and family who worked at those institutions who are great people, right? So you got to separate the individual from the organization. And so they're going through a tough time. There's all sorts of processes to get to the bottom of what really happened. And we're seeing a lot of that through the news cycles and congressional hearings. That's not for us to weigh in on. But we're exactly what Scott said is we're here to take care of our members. We have a very different business model. And I have to guess, Scott, we're probably similar to you, which is what we actually saw is a higher level of interest in talking to Travis by our members or prospective members, because you know who we are, we're always in the community, and we're very consistent. And so I would say 100% agree with what Scott said. We really focused on kind of owning our lane, demonstrating consistency, not making a ton of noise, and really just being there and answering questions during their uncertainty. I had the same exact, that Monday morning when we opened, post SVB, for those who have been around through the financial crisis, there's that very uncomfortable feeling that day you open and you come in and everybody was waiting for the shoe to drop. And what I can guarantee for probably Scott and myself is there was not a shoe to drop. There was some uncertainty. There was some settling of both our team members as well as our members. But by and large, we were a recipient of kind of a positive recipient of the outcome of that unfortunate situation. And you never want to be happy about something that occurs because it's bad. So we really just focused on, hey, let's make sure we take really good care of these new members, and especially those that are worried about making maybe rash decisions based on the headlines they hear. So I thought Scott said it really well.
Yeah, and in terms of trying to explain it to the public as an economist, I had to try to sort of walk that fine line too, because you don't want to sort of throw dirt on folks that are going through a hard time.
Yeah.
And at the same time, I think it's good to explain why it happened, how, for example, in the case of the credit union industry, I feel like the transparency in being member owned is one of the biggest positives to see about credit unions vis-a-vis these other examples. But for one of the things weird, and this is why I'm also bringing this up, is because Silicon Valley Bank having that footprint in wine country, the regional press, the regional viewpoint was just a little bit more hot light because of that exposure, right? So that Monday was a little weird. And I actually was in class on the Tuesday morning talking about this and my students were very concerned that this was the beginning of some weird end game in banking. And so I had to really, try to get them refocused. So as a microcosm of trying to talk to members, that was, it was a very intriguing couple of weeks. With that in mind, let's talk briefly about housing. So on housing, the North Bay, and if you think of the North Bay, I always think of the North Bay primarily as Solano, Napa, Marin, and Sonoma counties. We also think about it as Lake and Mendocino a little bit too, depending on where you are in the North Bay. But when we think about our housing situation, how are members translating some of the uncertainty in the way they're thinking about housing and mortgages? Because on the macro side, if we start talking about how rates might move, and I'll talk about this in a couple of minutes, against inflation and what the Federal Reserve's next move is, there's got to be some people out there thinking about housing or have thought already about housing and made that move, and what's it mean over the next few years? Have you guys been seeing mortgage markets kind of shift underneath your feet, thinking about where it's coming or what's coming next?
No question.
Please, Scott.
No question. I thought a fair amount about this. It's just such a dramatically different operating environment than what we saw in 2020, 21, and even in the first quarter of 2022. Financing costs for housing have just rapidly escalated since about the second quarter of 2022. And, the market was super hot. A couple of years ago, there was a lot of refinancing activity that was taking place. And you had 30-year fixed rates sub 3%. And you saw so many homeowners take advantage of that, and rightly so. I mean, those were historically low, great rates that people took advantage of to refi and lock in those monthly savings. But that refi market has pretty much flipped on its ear over the last 2 years. Also, the purchase market is just not as strong as it was. And I think there's a lot of reasons for that. Financing costs have more than doubled. Housing inventories have remained very low. I think a lot of homeowners are very reluctant to give up on the low-cost financing that they were able to secure back when rates were so low. And just because of the current rate environment, it's making it very, very, very difficult for people to afford homes, whether you're a first-time buyer or whether you're looking to trade up. And I thought it would be interesting just, to go back and take a look at 10-year Treasury yields, which are a barometer largely for, the mortgage market. And, even I look at it a lot for obvious reasons. I went back and I looked at the end of 2021. 10-year Treasuries were yielding $1.50, 1.5%. Today, they're 3.83%. So you look at all this, and it's had such a huge cumulative impact on real estate lending and the mortgage market. We still see a fair amount of interest in HELOCs and manufactured homes due to their affordability, but it's just a dramatically different environment than it was 18 to 24 months ago. And you nailed it, Robert. I always thought Orange County was an incredibly expensive place to live. I lived there for 25 years. I would posit that Sonoma might actually be a little bit more expensive than Orange County. And it's just a very expensive place to buy a home. We operate in Lake and Mendocino counties as well. We don't see quite the same affordability issues there, but there's just not as many homes for sale due to the difference in population density. So, that's my take on the mortgage market today and where we've been. And, I think we'd all like to see it loosen up a little bit.
Yeah, and even Napa County's gone gangbusters in terms of, if you look at what's gone on in the housing market there, not only were they somewhat affected by the fires in 2017 and still have a little bit of that shadow effect. When people left the core Bay Area, Napa was one of the places they stopped, and then thinking of starting, go over through Highway 12 and end up in Fairfield and start moving east. Kevin, what have you guys seen in terms of that? Because the thing about Solano County, where you guys are kind of the dominant player, is you've got a really wild contrast between Benicia and Vallejo on the west end, all the way up to places like Dixon, and then really creeping up a little bit on Davis on the east end. What have you seen in your markets in terms of the way people are looking at house? Because, with Scott, I live in Sonoma County also, and so that's sort of my viewpoint, but I'd love to hear your perspective on what's that long perspective along I-80.
So great question. So I'll cover a couple of things. First is, we've all seen the same kind of dramatic decline in kind of first mortgage, some pickup in home equity, lines of credit or loans. It's a natural kind of counterbalance to, I've got equity, I want to do a project on my home. Same theme around, dramatically less moves, right? People are unwilling to give up, as Scott said, my 3% mortgage to go to a 6%. So I think the point you made that is a little bit different is, because of the incredible amount of building that's going on, particularly in Fairfield and in Vacaville, where you've got large tracts of land where new housing developments can go in for California, and I'm a new resident of California as of last year, for a relatively more affordable price, then you're seeing an in-migration of folks into those more affordable areas. So it's kind of an interesting balance. To your point, we are seeing an uptick in people moving into the Solano County area, and it's kind of these interesting pockets. The other topic that I have to imagine is happening everywhere is you've got home affordability, and you've got a lot of discussion around ADUs. Mm-hmm. And how do we think about the intergenerational thing that's going on? Because honestly, if your parents have paid off their house and they're living in their home, and that home, based on the other statistics we've all seen, would likely have been a new family starter home, but your parents aren't moving out, I think there's going to be a long tail on this discussion around kind of intergenerational housing, and how do we enable people to age in their homes while not causing a backlog in those first-time home buyer markets, because that's honestly a lot of the stress is there's constraint, there's new building, but it's all about price point, right? And then you've got the sticker shock of, hey, I can afford a $500,000 home, and what's on the market is a $850 and above. So we're kind of seeing that tale of two cities, kind of no pun intended, but we're going through that exact same experience.
No, absolutely. And in fact, one of the things I've seen around California is a lot of discussions about, is there a way to provide incentives for seniors who are in a 4,000 square foot home that they've owned for 30 years, basically have paid off, to move into something smaller and downsize and potentially have their family come in behind them
Yeah.
in such a way to have this sort of intergenerational shift, not only in wealth, but really in kind of the community shock on a positive side of bringing a family in versus getting sort of slowly aging at a faster pace.
Yeah.
Marin County, Napa County, and Sonoma County are kind of poster children for the other movement, which is we're getting older, staying in place. We're in relatively low, potentially refinanced homes. So we don't have any incentive to put the home up. But I also don't have an incentive to necessarily transfer it to my kids because where would I go where I wouldn't either reset my mortgage cost or not be able to cash out of my house and afford to buy something of basically the same amount. And that sort of shell game of not wanting to leave the area, but not knowing where to go is something to watch over the next 10 years as our population continues to evolve. It should be kind of intriguing.
Yeah. The other thing I think we see a
Please.
fair amount of is and again, it's probably more unique to California based on our climate, which my family is very much so enjoying, is the role of energy stability and solar. You know, in the Solano area, there was a large opportunity that was lost from a new company coming in to build a kind of state-of-the-art warehouse, kind of maybe in the biotech example, and we couldn't get power for 2 years. So I think, there's a lot of discussion. I'm involved in the Solano County Economic Development Council, a lot of discussion around microgrids. I know obviously Sonoma really faced this coming out of the fires, and how do you think about sustainability? So I think, again, another topic where I don't know the end outcome, but I know we're going to keep having a lot of conversations around consistency of power to our members, to our business communities, to our nonprofits, and how do we think about tackling that as a kind of coalition of leaders versus just see what happens this month. So that's a topic we're talking a lot about.
You bet.
I think Kevin brought up two really good points there on ADUs and solar. And Robert, your credit union, which you sit on, as a board member, has products in both of those spaces. I think ADUs in particular are an opportunity to get a win-win on both sides of the equation, if you will, and certainly cleaner, more affordable energy options for people who are going to stay in their homes longer. I think Kevin said it very, very, very eloquently. I think there's an opportunity for credit unions to come together and capitalize on that as well.
But I don't want to stray too far because we do have a couple other things I want to cover here in the next few minutes. But on the ADU side, do you guys feel like that? Because when the ADU sort of beginning of the revolution started, if you want to put it that way, I was actually kind of flabbergasted we didn't see more action. And I don't know what part of the market didn't move, but it felt like that, at least when I talked to people and kind of thought about it as an economist, that it had to be that there just wasn't the demand that was expected. I think the supply conditions were kind of there, especially coming out of the Great Recession, but that people have really started thinking, do I want to take on what I think is an ADU, whether it is a separate residence or some other part of my residence, and however I want to define that. Do you guys think there was something that maybe held up an initial movement of that we've been still waiting to have in full?
Yeah, I can
Please
give you my opinion. I think there's two things. I think one, lots of confusion and rhetoric around zoning. And two, I don't know if you've gotten the pleasure of getting in a direct mail piece from some of the ADU developers, for the low price of $200,000 for a 900 square foot place. Well, that looks a lot like, so I think there's what ultimately is going to draw. So you've got to figure out the zoning and how do you do it in a way where it's a community rallying around it, not Scott takes from me and I take from Scott. So I think that's the first. And then I think second, part of the discussion that's at least occurring now or starting to is we've got to figure out a way to bring down the price of that unit, because then you can get your head around, I know what to do with my in-law who needs to live with me because they're at that phase of their life where they can't live alone, but they can live with us. As an example, the use case has got to be it's got to be not overly friction full, or else the default is not to do anything. And I think, unfortunately, that's kind of where we are. And there is stuff happening, but it's definitely kind of stuck.
Yeah,
I know, Scott, what do you think?
Yeah, no, I agree with both of those points. And, as someone who has an aging mother who still lives in Orange County. I've considered that ADU option for a lot of reasons. And it is somewhat complex. You've got the building permit issues, you've got the zoning issues. What do I have to do? What do I don't have to do? And then, I think we've still had supply chain issues. I mean, I think there's a number of great, really interesting ADU options out there, and there's a lot of companies who play in that space. But at the end of the day, it still feels like a rather large undertaking and a fairly sizable capital investment, right? I mean,
Yeah.
if you build a decent 1,000 square foot ADU in Sonoma County, which has decent amenities for an in-law, you're probably looking at about $450,000, which is a fairly sizable investment. And then you just take the general uncertainty and malaise of the economy combined with that. I think people are just kind of like, maybe I'll just let this kind of coast on ice a little bit until there's a little more certainty around this. Maybe I have some more certainty around my financial situation. And it's a relatively new market still. Who do you trust? Where do you go? So I think there's a lot of that's going on with ADUs.
No, I know you guys kind of nailed it. That I think the sort of the core thread there is the confusion around what we're really doing either on the zoning side and what we can do, and then ultimately what's that leave me with on the other side once it's there. I need to be very certain that I want that outcome, and what am I going to do with it? What I want to do now, folks, I want to transition to talking briefly about the economy. So let me share my screen briefly. On June 1, I gave a talk at Sonoma State University about the economy. And what I want to do now is I want to kind of hit some of the highlights of that discussion. The big highlight is where the forecasters are for the US economy. And these data are from about 6-7 weeks ago. And these are looking at 3 specific data points. So we're looking at real GDP growth, or think about this as income after inflation. Then we're looking at unemployment rates. And then we're looking at what's the Federal Reserve's sort of favorite inflation metric right now, which is called core personal consumption expenditures price inflation. And what that means is you think about the shopping cart that you buy every month at home and you throw everything into it, but then you pull back out food and energy prices or food and energy goods and services. The percentage change in the price of that shopping cart on an annualized basis is what those numbers are there. And so that the Federal Reserve wants to see that number around 2%. And I'll come back and talk about this in just about a minute. But that's the conundrum to solve, is how do you not create recessionary forces and at the same time cure the inflation ills that we've been facing for the last almost now 2 years. So looking at real GDP growth, these come out quarterly. So what the Federal Reserve in Philadelphia does is they do a quarterly interview of 40 forecasters, and the previous quarter's growth forecast is in the not shaded column to the left of that shaded column. The new one, which is for May, is in the shaded column. And you can see that for 23 and 24, the forecast is actually flattened out a little bit. And that's because with lingering high interest rates and lingering inflation being relatively high, we do not expect much growth over the next year, but we also don't expect a recession in a classic sense. Now, it's good to think about recession is a declared state of the economy by 5 economists who basically make that statement, not an equation. There's a technical term, or a technical way of thinking about it, which is 2 quarters in a row of negative GDP growth after inflation. We saw that the first 2 quarters of 2022, but there's no expectation we're actually going to have a declared recession through at least 2025 or 2026 at this point, which is good, but the economy is going to move very slowly. Now, the unemployment rate, and we talked about this right off the top, is that one of the concerns from the credit union standpoint is how hot the labor market's been. That heat is not likely to change anytime soon, and that's maybe because of something we're going to talk about in a minute, which is population change, but also because we're still seeing, we're in the kind of the same recovery sense we've been in since right after the pandemic ended from a recession standpoint, and then we started to lift off as we opened the economy. We're still looking for workers, and employers still want to hire. So the unemployment rate, while increasing, is primarily because we're seeing just net movements of people back in toward the labor force, and not, in a sense, hiring them all simultaneously, but hiring them at a decent pace. So we're getting growth in the economy, a small uptick in the unemployment rate, but nothing dramatic like the movement to 5 to 6 to 7% like we've seen in past recessions. And the unemployment rate will start to fade, assuming that the higher interest rates and the slower growth of the economy. So if you think of that first shaded area, real GDP growth, and that third shaded area, core PCE inflation growth, those two should be moving in opposite directions for the most part. And we see that dynamic there. We need to get that inflation down, and the Federal Reserve is going to be watching that inflation more closely. And that has not quite ticked down at the same pace that we've seen the so-called consumer price index tick down So until the Federal Reserve sees that moving down in pace toward those numbers that are being forecasted toward 2024 and 2025, they're going to either keep interest rates where they are or certainly not cut them. So we should expect that this year's going to be slow and next year's probably going to also be slow. And that a lot of that's just simply the lingering opportunity cost, if you will, of how we salvaged the economy right after the pandemic really seized hold of our economy and of our job market. If we look at what's going on in labor markets, I want to show this for the 6 counties we talked about earlier that are the North Bay and also for California. This is a look at labor force for the number of people that are working or actively looking for work in each one of these 7 areas, but it's going to be compared from January 2020 to April 2023, which is the latest data as of today, which is basically mid-June. This is where Lake County is. This is Lake County, Mendocino County, Marin County, Napa County, Solano County, Solano County, then Sonoma County, then the state of California. So you can see that in our region, there's somewhat of a mixed bag of recovery. So when you see a column go above the red dotted line, it means that jobs growth or the number of people that are available for work or working has gone above where we were right before the pandemic. And if it's below or has a number less than 100, it means that we haven't quite recovered yet in terms of our labor market. So one of the things about this Northern California region that has been a relatively hot labor market is because we've also not had as many people available for work, which has made it tough for employers to find the right number of workers. And that's also true of the state of California. The entire state is still somewhat seized up by this problem. It's Napa County of all these counties, and to a certain extent, Lake County, which have basically recovered the fastest. But we're watching these other counties as they've slowly crept up toward that red dotted line. We're hoping sometime later this year, most of these counties have gotten there. But one of the reasons, if you're an employer in this region, you struggled is because we haven't quite seen the number of workers come back yet in full. This is the housing price forecast as of April. Now, in these months, basically from July forward to March, Zillow's research group, which is the best public database out there on housing in terms of my opinion, we're forecasting a downturn over the next 12 months. And that sort of followed higher interest rates, price fatigue, and some of the things we talked about earlier in terms of the housing market. In April, they turned that forecast around to a marginally positive one. And instead of having many of the counties in negative growth over the next 12 months, almost all of them are now in positive growth, except for a couple. One is Mendocino County, unfortunately, but just barely, but also San Francisco, just barely. Sonoma County, and you've noticed those names on the far right-hand side with relatively low growth are names that if you're from Northern California, you'll recognize relatively quickly. Our market has just had a little bit more price fatigue and a little bit more exposure to a lack of available units than other parts of California. But if you look at the left-hand side, that I-5 Highway 99 corridor has continued to really kind of move forward at pace. And those job markets have actually been very good in terms of success stories in California coming out of the pandemic. But the good thing about this is that from those forecasters' viewpoint, it looks like housing markets are turning around. The trick there is where interest rates go and whether or not buyers are willing to jump back into that market with a lack of units otherwise. One of the biggest things looking forward is population. So if we look at population forecasts, I'm going to show you, this is the North Bay, again, those 6 counties all put together. So from 2019 forward, this decade is going to be one of sort of a change of migration and then slowly kicking back up in terms of people coming back to this area or the population having more kids and actually seeing that population start to creep up over the next 20, 30 years after that. Now, notice that even if that's true, the current demographic forecast is really not to get much above 101, 102% of the 2019 population level in those 6 counties all combined by 2050. Now, why is that true? Well, if I took Solano County out of that mix, this is what the North Bay population progression would look like. So the main reason why we even have a positive population forecast for these 6 counties combined is because of Solano County kind of balancing us out a little bit. And then California, so the North Bay being kind of a microcosm of California, actually looks like this. And the reason why it looks so dramatic is because of the Los Angeles area. The current forecast is that the Los Angeles area is going to lose population. And historically speaking, Los Angeles has been somewhere between 30 and 35% of the state's population, at least over the last 50 years or so. So that change in population then feeds back into available workers, feeds back into housing markets, and has a lot of community outcomes in terms of the way we're going to see change over time, and will also age our population. And that's really kind of one of the big things to think about if for credit union members, housing markets, and really for our credit unions in the way that we hire. We're going to see fewer kids in schools. So right now, the North Bay has got about 12 or 13% on average fewer kids in schools, in public schools, by 2030 than there was right before the recession or right before the pandemic began. That's also going to put higher pressure on our community colleges and our local universities. So watch all that kind of moving hand in hand, especially when we draw from a regional audience for higher education. And then we'll see what that means for housing demand. So we have a lot of homes to be built in this region, as we do throughout California, and our governor's jumping up and down talking about having to build homes. We just got done talking about accessory dwelling units as one option in terms of building homes. Will the demand be there? And this area is not unique in terms of the way that population is moving. So if you look at the more rural areas of California, the demography and the forecasts are very similar. So these are the ways that I'm looking at the economy over the last few years, and kind of starting to think forward as what headwinds and tailwinds kind of are affecting the region and California overall. One thing about the league is there's a lot of other resources out there, and we're going to have what's called Your Economy, Your Credit Union as a conference coming up in July. But E-Train's got a lot of educational products out there, so check out that, and also contact Angela Daly. She's great in terms of directing what you need at your credit union, so please check that out. So folks, I want to end with what do you think are two opportunities? Kevin, we'll start with you to wrap up. What are opportunities for both members and for credit unions in our region?
Yep. So on the member side, I think there's continued opportunity, especially given our earlier conversation, for the credit unions to pick up market share and member base by serving those that are basically disenfranchised by the national players, the drama that ensued, both, for those that are serving a very different member segment than Scott and myself and our team. So I think that to me is continued opportunity. The challenge of that is we've got to be really crystal clear on our message and why us versus somebody else. So that's kind of opportunity one for the kind of overall movement. And then I would say for Travis, our opportunity is really, we have a historical base in Fairfield, Vacaville, and what we're really looking at is we do incredible work in financial literacy in the schools. And what we're really working on is how do we extend that to even more members, to more schools, to make sure that we're really kind of empowering that next generation of informed consumers, to make sure that whether they're a Travis member or not, I hope they are, but that they're really better positioned in their life to go ahead in terms of making wise decisions. So I think, to me, if you always lead with education and empowerment, you really can't go wrong. So I look at those as kind of our two contrasting, one industry, one kind of specific to Travis.
Scott.
Yeah, I think Kevin brought two outstanding examples to the table. Agree with both of those. We talked a lot about housing and affordable housing. I think just given all the dynamics in play, that's something that we need to just continue to evaluate and think differently on, just because it is such an expensive place to live. I think, when I look at that market, we have a relationship with Freddie Mac, but a lot of our borrowers are looking at non-conforming loans, because they're over the high value dollar limit. And, I think credit unions, somewhat been reluctant to put 30-year fixed jumbos in the portfolio because of the corresponding interest rate risk. But, I think you're seeing more people now also look at what I'm going to call the appropriate use of derivatives to maybe put more in the portfolio and be able to hedge some of that risk, in regardless of what's happening with rates, either up or down. So I think there's an opportunity there for us to be a little bit more aggressive in that market, and through the proper use of a derivative strategy, potentially to put more in the portfolio and be able to reach more borrowers. I think the other thing is, and I think this is evergreen, and I think COVID exacerbated this to a great extent, and that's just digital convenience for our members. We love when members visit us in the branch. We love to see them. We love to talk to them. But I just think it's essential that we continue to offer members more easier and convenient ways to have experiences with us. We fully expected a tight operating environment heading into 2023, but we've made some rather significant investments in digital capabilities longer term for precisely that reason. And I think we just need to keep leaning into that as an industry. I mean, it is omni-channel. We want our members to have the same experience, whether they call us, visit us in a branch, or have a digital experience with us. But I think just continuing to lean into digital transformation, because we have great products and services, but if there's friction and they're difficult to consume, that gets a little bit uphill in a hurry. So I think that's incredibly important for us and all credit unions moving forward, is just to continue to lean into that.
Yeah, and I feel like that's the difference, is that not only do we educate, but that we really want to be as omni-channel as possible and make it easy to access those tools for people's lives. Awesome, guys. Well, thank you so much for your time. I appreciate it. And folks, I want to thank the league again for making this happen, and thank you all for checking this out. Guys, have a great year, and I hope to see you soon.
All right. Bye, Kevin. Bye, Robert. Thank you so much.
See you all. Bye-bye.